Okay, well, good afternoon, everyone, and welcome to this edition of the Leader Collective at Bloodwater's webinar series. I am so excited today to welcome back to our community a familiar face that many of you know. Maybe this is a new face, a new introduction to some of our newer partners who have joined this year. I'd like to introduce Joseph Masika Mutunga, who is the founder and managing partner of Mutunga, Masika and Associates. Masika is a finance, accounting, management, and auditing professional with over 16 years experience. And he has a special interest and experience in supporting the nonprofit sector that cuts across NGOs, CBOs, churches, and other kinds of public benefits organizations. Masika is a long-standing part of the Bloodwater community, an institutional partner to our work. So for many of you, Masika is an old colleague and friend within the Bloodwater community. We are really excited to have him on board today, and this is the first of 3 webinars that he will be doing for our focus this year, which is on financial health and viability. And so for today's session, he will be walking us through understanding your organization's financial health. I will hand it over to you, Masika. Welcome. We're so happy to have you here. I will start the screen share and follow your lead.
Yeah, thank you.
Great.
Thank you, Nadia, for the introduction, and thank you everyone for joining in. I welcome you to this webinar session. It's been a privilege for more than 5 years now, working with and supporting Bloodwater and Bloodwater partners, and I can only say, may it continue. So today, after discussions with Nadia and Bloodwater colleagues, we decided to have a discussion on understanding your organization's financial health. I will take you through this. I hope we can have a session at the end for discussions, for questions, and because of the numbers and time, we probably will not have everyone introduce themselves at this point, but as you ask a question or interject as I present, and by the way, feel free to do that. If there's something that you really must understand before I move on, it would be good to introduce yourself individually at that time. So welcome. So today we discuss what I consider to be a very interesting topic. Interesting in the sense that this is a question that virtually everyone I know of that is involved in financial management and things around accounting and administration seeks to know. And this is not just and this is not just about those who are directly involved in financial management, but also those that are involved in leadership. I'm just seeing a message from Nadia asking that I say my name and organization. Well, I had thought she had done that. Let me do that again. My name is Joseph Masika Mutunga. I prefer to be called Masika, but many people call me Joseph, and that's totally fine. I work for an audit firm and an accounting firm called Mutunga, Masika and Associates, certified public accountants. And as Nadia mentioned, we have done auditing, accounting, financial management for different organizations. And also for Bloodwater, we have been partnering with them for a while now in those areas, plus more. And not just for Bloodwater itself, but for Bloodwater partners as well. Those who are here and many others that are not here. I'm also joined here by my colleague, Simon, and probably one or two other colleagues and friends might be joining us. So I think it's okay. We can proceed. So I was saying that this topic is of interest to so many people. You think about it this way. You are a finance manager. You've just been recruited to head the finance department, and you have a job description. And this job description, as I have seen for many organizations for finance managers, is a huge document, at least 4 or 5 pages, that has roles here and there. And many times the incoming finance managers get overwhelmed by all this. And so it is important for someone like that to look at the organization and what they have come to deliver and ask themselves, after I've been here for 3, 4, 5 months, and then 1 year, and then 2 years, how do I know that I'm delivering on my mandate? How do I know that this organization is financially healthy and I'm playing my part in ensuring that that health continues moving forward? Or how do I assess that at the very beginning? So that's a finance manager. But think of someone else, an executive director, for example, and wishes to know, how do I measure my organization's financial health? It's even more complicated if this director is not a finance professional, and yet in their portfolio and mandate, they are required to supervise the work of the finance manager. So you can imagine the dilemma here. You are to supervise someone who, technically speaking, is actually more qualified, more experienced than yourself, but you have a managerial role over this department, or any other supervisor who may not necessarily be an executive. So this session seeks to explore 4 different elements in financial management, and I'll be speaking about that shortly. And in these 4 elements, any person seeking to assess an organization's health looks at them individually and also collectively in such a manner as to say that if this organization has met the criteria against each of these 4 elements, then it is financially healthy. And this is simple enough, not just for finance managers, but also for non-finance managers. At least I've tried to make it as simple as I possibly could. And we need to understand our financial health as an organization so that we know the areas that are working well, we can retain that. The areas that are not working well, then we strengthen that, we improve on that. The risks that the organization is exposed to, and seek mitigation measures to make that better moving forward. So that's really about this webinar overview. And then in the next slide, we talk about the 4 elements of financial management, or the 4 pillars of financial management, such that whereas these are individual pillars, they are actually interdependent. Yes, there is a sense in which they are organized in this order. So planning first, then operations, and then quality control, and then stakeholder management. But in another sense, they interact in such a way that if one doesn't function well, then the other seems not to function well as well, and they interfere with each other in that way. So financial planning, budgeting is the starting point. Everything needs a plan. After planning has happened, then implementation must take place. and that is operations and processes. As you do that, then you need to check whether everything is in place as it is meant to be, whether there are cracks along the way, there are gaps, and what measures have been put in place to ensure that should that happen, then there are mitigation measures to bring the operations back to normal, and that is quality control. And lastly is reporting and stakeholder management, which is the last end of it, like the result of all the first three elements, because we operate to work with others and not just with ourselves. So there are stakeholders that we deal with. As you would see, financial planning is the starting point for all management of all the other elements hinged on it. Whenever we talk about budgeting, then it has to start from what is the justification for the need for monetary input or resources, and then how do you prepare it? And the preparation in this case then is about setting the outlay for the budget, monitoring it, and then reporting. So those are the four elements that we'll speak about one by one. So we start with the financial planning. In financial planning, there are different sections of it. So here I've put it in 4 different sections, and feel free to consider them as 3, consider them as 2, or one long one. I've just put it for purposes of ease of understanding. So the first one is what I would call your overall financial strategy. What I've found is that many organizations do very good strategic plans, which is their long-term organizational strategy. And it covers many areas, an introduction of who they are as an organization, what they do, how they plan to do it over the long-term period, and the resources that they need, and the people that they will work with, what I would call stakeholders. So that exists, and people do that quite well. What I have found over and over, looking at different organizations' strategic plan documents, that there's rarely a case of a financial strategy being input as part of the strategic plan. And this is what I mean. So you have, let's say it's a 5-year strategic plan, and you have objectives, you have activities, and all that you plan to do. Now, that needs to be converted in monetary terms and a financial strategy to be developed as a result of that. So I would expect that after a strategic plan, or in the course of preparing a strategic plan, you would have a case where you quantify how much it would cost to run that strategic plan, determine where you would find funding for the strategic plan, and if there are deficits, then how to go about the deficits. So that would be a good financial strategy, and it would be good. I would ask that each of us, when we go back to our offices, let's relook at our strategic plan and check whether we actually did something like this or something close to this. And if not, then that may be an issue you may consider revisiting as a way of strengthening your strategic plan. So a lot of the strategic plans, financial strategy, would have an income section and an expenditure section. The expenditure section may, like in any other budget, either follow the programs or the different expenditure lines. Whichever route you decide to take, that is still okay. Nadia, if you could present the document called Financial Strategy. It's a one-page document among what you have from the pack, so that I can just mention how this might look like in case there's one who thinks it's a very complicated thing. In fact, for me, I would say a financial strategy as part of the strategic plan should be as simple as possible, as high level as possible, and with as little detail as is necessary for strategic planning, and only provide far more detail in the annual plans that come on an annual basis later as you implement the strategy. So if you look at this, you have a financial strategy. It's actually what most of us write as budgets, only that in this case, you have one that is for 5 years. As simple as it looks, you have funding or income outlay on the first part of it. On the second part, you have the expenditure or the outflows, and then you have the balances. So in this case, we have a case where the income matches the expenditure fully. It doesn't have to be like that, but it would be good that anytime you carry out a financial strategy or carry out a budget, then it will always be such that the income plan and the income total should be higher than the expenditure total. At worst, it should be equal. Then after placing such an outlay, it is important to have your notes that accompany the budget. I've called them here assumptions, and it can be anything about your sources of funding, what resources you're going to use, and your applications of these funds. Where will you place them? And will all your grants come from donors, or are there possibilities of raising funds from rent, from income generating activities? Like in this case, we have rental income for this XYZ NGO. So that is a financial strategy, as simple as it looks. And so I go back to the original slide. After you've done your financial strategy, then you have the periodic budgets. Most of them are usually annual budgets. This is where I find most organizations lay a lot of emphasis on, and that is fine. The only area I would like to place further comment in is that let that periodic budget, like an annual budget, be in line with your long-term financial strategy, so that an annual budget is actually a cascade of your financial strategy, your 5-year financial strategy. There could be changes here and there on an annual basis. That's acceptable, but let the reference point always be your long-term strategy. Then you have specific budgets. For example, it could be a program budget or a project budget or a grant budget. And then lastly, you have activity plans. So for example, assuming this webinar was one activity in an annual plan, then there would be a budget for it, resources that would be put to ensure that this happens. This then would be called an activity plan. Okay. Thinking about why we go about budgeting and controlling budget, something that is very well known to most of us. I will just quickly skim through it. We have budgeting so that we can estimate funds that we need to carry out our programmatic and administrative activities. We have budget also to inform our thinking as we carry out day-to-day implementation. What I mean by this is that there is a value at the point of budgeting in giving thought to what may happen as you write down your budget. What I have found is that a well thought out budget makes it easier to handle problems as they arise later, because then you would be able to refer to the assumptions you made, whether those assumptions still stand, and then adjust if need be. Assuming you had not done a budget, then it means that thought would not have happened in the first instance. And then when a problem arises in future, you don't know where to start from. So, for example, you worked assuming that you're going to get funds from donor XYZ, and something happens mid-year, and you only get 50% of what you expected from donor XYZ. The fact that you thought about it and put 100% of the funds from donor XYZ as you are planning, it means that if that changes, it is easier for you to go back and relate to the activities that were originally thought about when planning, and know that these are the ones for me to adjust. So there's a reference point. It is important to write budgets for that purpose, reference point, and managing problems as they arise later. Of course, budgets are an accountability base for spending and program accomplishment. We prepare BVAs, budget versus actual variance analysis. It is also a way of monitoring income against expenditure. As I said, do you have enough income to cover your expenditure? And then it's also a tool for fundraising. Should there be deficits, then at least you have a basis of activities that have been monetized. You have income, you have expenditure, there's a deficit, and you're seeking further funding to cover what has not been covered. So the question someone might ask in my next slide is, then if you are a member of the management and not necessarily he who prepared the budget, what are some of the questions you would need to ask or considerations you may need to have as you look at a budget, as you review a budget? I've placed a few, feel free to add as you go along. One is to ask the question, are we addressing wants and aspirations of our stakeholders and responding to our strategic plan, or are we just following the wind, as it were, where the money is, and that is where we are going? So is our budget a reflection of our strategic plan and also the aspirations of our stakeholders? And stakeholders in this case is broadly talking about who we exist to serve and who we walk along with as we do this. So our staff, our partners, our donors, all those are stakeholders. So who do we exist to serve? And is our budget a reflection of that? I know there are dilemmas sometimes when funding is available for things that you are not registered to do. And that is an issue that management has to deal with, because many times if you take it up, then you probably do not have the capacity or even the motivation to implement it. If you don't take it up, then you also have funding deficits. So it's a difficult one. And I think I've always gone for the first one, where we only consider funding that is aligned to one's strategic plan and that is aligned to the purpose of existence of an organization. Okay. I see a question here. Let me pause a minute to look at it. So Norman asks, what can be the key determinants for the increase in yearly income for overall financial strategy, looking at a period of 5 years? Sometimes assumptions look impossible. That's a good question. Norman, if you don't mind to just raise your voice, ask it in more detail, and probably anyone who may be available to respond to it. I have my thoughts, but let me hear first from Norman. Norman?
Yes, my question is on what if there are some key issues which we can consider when you are developing a state for a longer period, because sometimes you may have the picture of the income from the bonus, but sometimes at the longer period, the pictures looks more impossible in terms of being it a 5 years plan. Definitely you have to increase the amounts as the years goes. So yes, so towards the end of the 5 years, the figures may look maybe sometimes not realistic.
Yeah.
I understand that there are the assumptions, but sometimes you just adding the year amounts based on the period, but not really from the sources of the grants or sources of income.
Okay. So to this in a broad way, but it's easier said than done, in the sense that you can only cost and place in a strategic plan funds that have been planned for. So you have activities, you have your objectives over 5 years, you have activities that you set to meet those objectives over the 5 years, demarcated per year. So you have year 1, 2, 3, 4, and 5. And if you have clarity on the activities as the years progress, then it is only then that you can monetize it and place a costing against the activities. Now the challenge is then, one, do you know the costs as the years progress? We are in a very dynamic world. Fuel costs $1 today, $2 tomorrow. So we don't know what will happen tomorrow. Number two, it's possible for us to plan for activities that will become irrelevant in the second, third, or fourth year, or in the fifth year. So that is the dilemma that many people face and cause them not to plan. But I encourage you, in spite of those dilemmas, and in spite of the fact that those dilemmas are real, go ahead and plan. Think through year 1, think through year 2, 3, 4, 5. Cost them. Now, when it comes to costing, of course, then you could consider looking back and in your current situation and know what are the possible price changes over time. And it's still an assumption, and it could still be wrong, but it's best to still consider that and have a factor of increase on the prices based on the activities for those 5 years. And that is why you have annual budgets drawn from these long-term budgets to look at the reality of that year and then plan based on the reality of that year. When it gets to the second year, you do the same. If budgets have to change, then let them change based on the realities that year. Now, remember the point that I had made in the previous slide that planning equips your mind to handle problems that arise later. The importance with planning in year 1, even if when it comes to year 5, there'll be so much change, is that planning already equipped your mind on possibilities. And as those possibilities kept changing, then you were changing with those possibilities and adjusting to the most, the closest to the reality position at the time. You are better off by far than anyone who did not plan because of the fear of changes. So I would say those would be the main thing. Plan based on activities, cost based on current reality, and adjust for other factors like inflation and price changes for the months and the years to come. I don't know if that in a way responds to you, Norman. Or also if anyone else wishes to add something.
That said, that's well explained.
Okay, thank you. And then we go to the second question, is that it's good to work with the amounts that we have, living within your means, but to remain aspirational. So consider the amount that is available from donors or other sources while you're planning. So the other strategic budget review question, maybe you could move to the next slide, Nadia. That costing of your budget must be based on some reasonable grounds. It's not just picking figures from the air. It has to be based on some reasonable grounds. Reasonable grounds could be anything like what is currently available in the market, what you're able to get from specific quotations, and if it is like in the next line, about indirect costs that are shared across different programs, then having a certain basis that apportions those costs across different projects. So there has to be some basis, and it is good when you write your budget notes, you indicate the basis upon which certain figures were arrived at. And lastly, I indicate that it is good to also think about yourself as an organization. Do you have cost principles? By cost principles, it means those things that you say for sure you are willing to accept as your expenditure, and things that you're not willing to ever accept as your expenditure as an organization. It could be based on preference, it could be based on a certain value that you hold, or it could be related to the law. Is having a good, you have a good accounting system, you have good templates, modes of reporting, frequency of reporting is clear. That is what I would call infrastructure of finance. Secondly, there has to be a good environment that creates a culture of discipline. And that is only possible if you have a conscientious governance structure and management structures, including the individuals that hold positions in that structure. So that's really it about financial planning as a strategic process. And I wish to move to the next by saying that relationally, and by relational, I mean, how does it relate with the other three elements of financial management, is to say that it is the foundation. It is the infrastructure upon which all the other elements are built. If you get it wrong at planning stage, at budgeting stage, at critical thinking stage, then it is very unlikely that your operations, your quality controls, and your stakeholder management will be successful. Okay. So the second part of the elements is operations and processes. And it's interesting that this is where the finance department is most visible, because it's really the wheel or the oil that runs the organization. And the two main functions under operations and processes is accounting / administrative functions, and the second one is finance function. I know there's a very thin line between these two terms, accounting and finance, and I wouldn't want to overemphasize or really make a big deal of the differences. But for our purposes of this session, let me try to draw a distinction between the two. You will find that in many organizations, we have staff that are called accounting officers or an accountant, while others are called finance officers. And many times when you look at what they do, you're not too sure whether they have crossed over from one side to the other, because a lot of the functions in the finance department, and remember, it's actually called finance department in many organizations. If you're keen about words and it means something to you, you probably need to check accounting department, because there's actually a difference. So in accounting, we are talking about the whole process, step by step, that manages transactions from beginning to the end. So it's what in school we would have called the accounting cycle. So you ask the question, how are transactions initiated? Through need identification, through payments are made, documentation is filed. Those transactions are posted into an accounting system. From the accounting system, financial reports and statements are drawn. These financial reports are served to many audiences, either internally as management reports for decision making, externally to auditors, and then the cycle starts again. So that is the accounting cycle. And then we have the financial function. In a way, it overlaps with the accounting cycle, but the distinction is that the finance function talks about the decision-making process within the organization, the structures that are set to ensure that there are no bottlenecks and there is clarity on financial management. So for example, ensuring that there is a proper policy, that's a finance function. That there is a scheme of delegation, that there are procurement thresholds, the signatories to the documents are properly approved, budgets are properly referenced. Should there be a change in budget, then what is the process? Should there be a huge variance, then what happens? Who makes those decisions? Who has an override? All those are finance functions. In a way, they relate to accounting, but they are actually distinct. So the end product of accounting in itself is that whatever has happened has been recorded and can be reported accurately. That's a distinct product from an accounting process. While the finance function, the main product is to ensure that the organization is able to function, operate, and exist in a financially healthy environment. In it, of course, there is an accounting aspect, but the finance function is more overarching. I hope I have made that more clear and less confusing, but should there be some measure of confusion, feel free to let me know, and then we can discuss that. So that's about those two main areas when it comes to financial and accounting operations. So if we move to the next slide, you will see that the main focus is to ensure that that which is posted and captured correctly. Those in IT have the term garbage in, garbage out when it comes to information technology and other similar systems. We are together with you in that sense, IT people. Accountants strongly believe that as well. So if there isn't accurate capturing of transaction, then there's a lot of reconciliation that is required later. A lot of time is wasted on that, and it is very likely that reports that are churned from such a system cannot be relied upon. So the emphasis is reliability of information and a healthy financial environment. For that to happen, then you need to have proper, well-equipped resources, starting with human resources. So you have quality officers, you have a supportive management, you have a good software, you have policies and procedures and practices that go hand in hand to ensure that information that is recorded and eventually churned out is accurate. So the main thing that I found as a weakness with many organizations when it comes to operations is that there are a lot of documents and people sign. So you'd find, for example, a payment voucher has 4 areas to be signed. So there's preparation, there is checking, there is approval, there's authorization, or any other. The challenge with that is that whereas you will go and inspect as an auditor those documents and find that they are fully and well signed, if you actually challenge the individuals who signed what they meant as they placed their signature against those documents, not so many of them are quite aware. And it would be good as a challenge after this to go back to your offices and ask yourselves, if you look at a payment voucher as an example, and you have someone who has signed as prepared by name, signature, what does that really mean? And reflect on that. So for me, I would say anyone who signs as prepared by, what they are committing themselves to by placing their signature there is to say, on this voucher, any information, any detail, any activity that is represented by this voucher, I know it, I can stand by it, I can explain it in detail. It is the ownership signature, I would say, prepared by or requested by, if it is a request. And the second bit is checked by, usually done by finance personnel or admin personnel, where they are simply saying, assuming it's a payment voucher, that as I sign here, what I'm committing myself to is to say, I have checked and confirmed that there is sufficient cash flow for this payment, that it is the arithmetic is correct, that the person making the request has already liquidated the previous request, and that kind of check, so that they sign with knowledge. The third one is approved by. This is usually by, probably depending on your policy, the budget holder, who by signing is simply saying that I know this activity, it is an authentic activity, it is within our budget, and that the officer that is running this activity is actually aware of what they're doing, and I can vouch for it. That is a signature for approval. And lastly, authorization is a signature that simply states, given everything that that I've seen, that I have had, then let this continue. Let this activity take place. Let this payment be made. And that's it. So those are just broad strokes as to what those signatures would mean. But I would challenge you to go back and ask yourselves whether you are aware that is what you're doing while signing, and start practicing that moving forward. So in conclusion, I would say relationally, compared to the other three elements, operations and processes, I've written this in the next slide, is the wheel that moves all the elements. It's a day-to-day work. So you would all appreciate and recognize that it is through operations that you're able to sit down and budget. It is through operations that quality control takes place, and I'll explain that moving forward. And also management of stakeholders. Okay, so we go to the third element on quality control. So quality controls are checks and balances that the organization has within itself and from outside itself. So we are saying on a day-to-day basis, there are activities that are ongoing, transactions are taking place, reporting is taking place, activities are going on in the field. What is the possibility that errors happen, mistakes happen? Sometimes not really mistakes, also that there is a possibility of fraud, or there is a possibility that we are running behind schedule, or we are moving too fast in our activities. All those things could happen. So what are the measures that have been placed to allow you to first detect should there be a problem, and to have mitigation measures? And that is what is quality control as far as financial management is concerned. So here I have listed a few of those quality control measures within the organization. So I've started within. In the next slide, I'll be talking about those from outside. So within, we have generally what we would call internal checks. The first one is segregation of duties. So in segregation of duties, we are saying that as much as it is possible within your organization, your stage and your resources, no one transaction should be initiated, implemented, completed, and closed by one person only. It must pass through different hands. And a very straightforward example is the way we have different signatories when it comes to payments as a way of segregation of duties. That's a good internal control as a way of checking the quality of work. And this helps to ensure that if one eye cannot trace an error, it is very possible by the time it gets to the fourth eye, someone will have picked it up. Sometimes it doesn't happen, but most of the time it does and should. The second one is supplementary documentation, things like bank reconciliations or vendor reconciliations, supplier reconciliations. So the primary documents in this case then would be the transactional documents like vouchers, payment vouchers, invoices, receipts, all the support documents. But there's supplementary documentation are those that are created not as original ones, but to just check whether the initial documents, initial reports are actually accurate. Then you have internal reporting. So you have management reports. Some do it on a monthly basis, others every 2 months, others quarterly. And it could be reporting about yourself as an organization, the environment you are in, your being as an organization, as well as the progress of what you're doing as an organization. So in monetary terms, a lot of this is done through a progress report on maybe budget versus actual variance analysis, and any deviations are discussed. And it is possible that in the process of discussing this, then a problem is mitigated. The other quality control check is to always check the extent to which you are implementing your audit recommendations. I know many organizations start looking at the management letter from previous audits just a week or two before the next audit. And that one is so self-defeating. You have no time whatsoever to implement those audit recommendations. So having as part of your quality control a system where as soon as an audit is complete, the audit recommendations are placed on the table, and all those that are involved discuss it, and action points taken to ensure that any action point required internally is done, and done in good time. The sooner it is done after an audit has closed, the better for you as an organization. And that means that you're maximizing the benefit of an audit as opposed to where you wait until when it's very late. It actually means that you had an audit, you spent resources and time on it, they did a report, but that report did not benefit you. So it's good to always have a system that implements audit recommendations. Peer reviews, maybe an accountant checking another accountant, or another officer checking the work of another officer as quality control. Then you have field visits. So if you have an international office, so you have officers of the international office visiting the country office, or those officers of the country office visiting field offices, and just checking reports, checking implementation of activities. That is usually a good practice. Lastly, if you have board members constituted as part of governance, should they make regular visits to the organization, quarterly or half yearly, to just check on how the organization is, then that is a further check on internal controls. Okay. Then going to cases of checks from outside the organization, we have organizational audits. So whereas organizational audits are initiated by the management, many times it's a legal requirement if you are above a certain threshold, and the product of that audit usually goes outside the organization. So I would place it as an external control. The second one is revenue authority audits and returns. They could KRA, Kenya Revenue Authority, Uganda Revenue Authority, another I think is TRA in Tanzania. I don't know what the authority is in other countries, but they have a legal right to actually carry out an audit in your organization should they sense that there's something amiss. And they all usually require that at the end of a particular financial period, you do a return. That is a way of controlling what you do and the quality of your report as well. The government, other than the revenue authority, depending on your regulatory body that registered you, you could have registered yourself as an NGO, registered yourself as a company, as a community-based organization, as a society, all those related activities. So that's the government. Then it comes to donor-initiated audits. You could talk about an audit that is initiated by Bloodwater or by another donor. And again, the level of implementation of audit recommendations tied to organizational audit or project audits or grant audits would also be a check that auditors will always make at the point of audits. Okay, so that is quality controls, and I think it is important for organizations to always think about, have we set aside measures that that ensure we do not let things that are errors, mistakes, and fraud to go undetected. Okay. So in conclusion, what are quality controls? These are authentication measures, confirmatory steps. And it is important that a good eye and a desire by all members of the organization to be set in such a way that they want to see quality in everything that they do. Once that is set and there are systems to support it, then the level of mistakes, errors, fraud are likely to be lower and lower as time progresses. So relationally, as a way of conclusion, that quality control is the sieve that checks all the other elements. So I'll pause there before we get to the last item, which is reporting and stakeholder management. Any reaction so far as I sip some water?
Joseph, I had asked a question in the chat about the distinctions that you made with accounting and finance. Is there a distinction also between finance and admin, or is that an acceptable umbrella to house finance within?
Okay. So admin is a huge umbrella. It's a huge umbrella. A lot of things are under administration. So you find finances under admin, accounting is under admin, procurement is under admin, travel arrangements is under admin. So it's a huge umbrella, as I would say. I don't know if that responds to you.
So my takeaway from that response is that it would be acceptable because it falls under a wider umbrella.
Yes.
Okay.
Yes. Yeah. So if you have an organization that that primarily delivers certain programs, then it would be easy to categorize that organization's activities into two: program activities and administrative activities. And then now under administration, you have all the other subsets of it, finance and the rest. Okay. Then the last one is about reporting and stakeholder management. So in reporting and stakeholder management, and maybe as a way of introduction, and part of the reason why I consider this important is that there is an allegation or a stereotype. It could be true or not. I don't know. It's up in the air that accountants are not very relational. Accountants, finance people are just focused on reporting and following the procedures, and anything that comes in the way of that can be trodden over. So maybe it's true, maybe it's not. I'm not very objective because I'm one of them. But what we are saying is that as part of proper financial management, one of the pillars is to ensure that the stakeholders around finances are actually taken in consideration in a serious way. And the stakeholders are first the people that we exist to serve. Maybe you would say they are beneficiaries or their clients, one way or another. But at the same time, they are the people we work along with in the process. So we have funding partners, stroke donors. We have staff members. We have suppliers. We have debtors. We have creditors. All those are financial stakeholders, and of course the government. So while planning and running the organization, then it's important that all that are placed in consideration. So I will say, for example, and I'll start, I've placed this in 3 different categories. So there is internal, there is external, and there is contract management. So under internal, it means that one of the major stakeholders is the organization itself. So do we have a way of reporting and being accountable to this internal stakeholder? And that is why you have management reports, financial reports, including the budget versus actual variance analysis. And this could be in terms of operational funds. Answering the question of Nadia, this then would be administrative funds or funds for administrative purposes. And then you have project funds. And then you have other funds. Other funds could be things like reserves. Reserves are set aside for the rainy days when there is no funding and you still need to continue operating or to keep a certain minimal level of operation as you seek further funding. So that's reserves. Reserves could also be for certain reason, like asset replacement reserve. You decide that every year you're going to set aside 100,000 or let's say $10,000, so that at the end of 4 years, you'll have $40,000 to replace your current vehicle, something like that. That's an asset replacement reserve. Then you can have an endowment where you have funds set aside whose interest and any other income earned from it can be used for day-to-day activities while the principal is held constant. You can have designated funds for a specific project. Maybe you decide that there's a major project, a construction project, and every time you receive funds for it, before you get the full amount, you'll just put it in a separate account until it's enough to carry out that project. That's a designated fund. And you have capital funds, which is the monetary calculation of all the fixed assets that currently exist in the organization. So those are financial reports for internal purposes. I know I've skimmed through that very quickly. I can't go into the details for each of these, and you can separately seek me out for further explanation. But if there's something that's not clear even now, feel free to ask me. And then you have consolidated financial reports, which means those that put together all those 3 funds that I have talked about, okay? Then you have external reporting. So in external reporting, and this very closely mirrors what we talked about external quality control measures. So you have organizational audits, you have revenue authority audits and returns, you have the government's requirements, you have donor reports and donor initiated audits and reviews. So that's really it about external reporting. And lastly is contract management. So these are mainly not those you exist to serve, but those who serve alongside you as an organization. So you have suppliers of goods, you have suppliers of services, and suppliers for civil works. So there's a distinction here, mainly for tax purposes and also for process management. Goods are those that that can tangibly be felt. So you have a cup, you have furniture, you have fixed assets. Supplies of services, services are intangible. So you have consultancy services, training, education, health provision and such. And lastly, civil works, which is, it's a kind of good, but it requires input in its construction in a permanent way. So you have buildings and you have any significant repairs in a fixed form, that would be called civil works. So that would be what I would call contract management as a way of managing stakeholders. Now, I would encourage as a way of building relationships with all these stakeholders that should there be a problem, that accountants can actually sit down with these stakeholders. And I'm thinking, as I speak of suppliers, there are times when suppliers are claiming that these payments have not been made, while you're saying they have been made, or they have delayed, and you think they have not unduly delayed. So I would encourage that you sit down and discuss in a cordial way and not in a combative way, as we have seen the case happening many times. And even when thinking about internal stakeholders, there is this conflict or apparent conflict that exists between finance staff and program staff. So program staff are always saying that finance staff are either delaying funds or are seeking so much support documentation that is unreasonable in the circumstances, and they don't want this program to succeed. You can imagine such an allegation from a fellow colleague that this person does not want this program to succeed. While on the other hand, an accountant is simply saying, I'm doing my job. I'm required to keep accountability. So as part of managing each other and each other as stakeholders, it will be good to always think through a way of ensuring that your communication is such that you see yourself as partners in achieving a set goal that is mutually agreed upon, as opposed to having it as very antagonistic in nature. So as a way of conclusion, I would say that if you do not manage your stakeholders well, you'll actually fail as an organization. And each of the other three elements will also fail. What does it mean to plan so well, to have your operations running very well, your quality reports, your everything that you're doing doesn't hit snags, but you have a completely bad relation with your debtors, with your staff, with your suppliers, you will not move far. You'll be sabotaged. And that is why stakeholder management for financial purposes is very, very important. And in my last slide, I have said that relationally, reporting and stakeholder management is the result and tail end of all these elements. You can't succeed in the others if you do not have good relations with your stakeholders. Asante sana, thank you very much. As Amasagnalo, thank you for listening to me. I am open to any questions or discussion points in the next few minutes. I see we have a good time remaining. And I also use this time to appreciate Bloodwater and my colleagues at MMA for participating in ensuring that we have this presentation. Asante sana.
Thank you, Joseph. I think we will open it up for questions, reactions, reflections. You can just unmute yourself or put your thoughts in the chat.
So I'll also use this time to check if there are any messages as questions.
I think you captured them all along the way.
Okay.
Well, great. I'm not sure that there are any questions. So maybe just as an overall reaction, Masika, this has been really, really powerful. Just at the end, the connection of how everything one feeds into the other in terms of overall success, success missionally, success relationally, just as well as it is operationally or functionally. Yes, for Kennedy, we will share the materials for everyone who is registered because we have your email. We will share them. I put in the chat earlier the sample finance strategy that Masika had referred to, but we will share it again in the email for everyone who had registered and attended today. So I think if there's no questions or reactions, although we are ahead of schedule, I could just say thank you to MMA. As always, just another demonstration of why this partnership has been so incredibly valuable. Elfaz was reflecting in the chat. Is this the same Masika who we met at the Partner Summit in Addis in 2017? And I said, yes, it was. So just a demonstration of how memorable and how longstanding this relationship has been. I think just one thing to say thank you is that over the years, you have been such a committed partner to Bloodwater in terms of, not particularly around checks and balances or accountability and risk, but really more so a partner for seeing our partners and even Bloodwater move towards goals of financial health and wholeness, and really helping our systems collectively as a community be strong, be viable, and reflect what our organizations need to do our work well and to live into the fullness of mission. So on that note, this is just to say thank you. This is the first of 3 sessions that we're looking forward to help us move forward in another way towards financial viability and health as organizations that are working to see transformation in communities in different ways across the continent. So thank you, Masika. Thank you, MMA, to everyone who attended. Thank you. And we will make this recording also available. So if your colleagues were not able to join for one reason or another due to connectivity or conflicts in scheduling, we will make this available for everyone. So maybe just a final request, if you are able to turn on your video so we can at least say goodbye as a community and wave ourselves out.
Okay.
Great to see everyone. Thank you for creating space for today.
Thank you.
Bye.
Thank you, Nadia. Thank
Bye,
you, everyone. And all the best. Bye-bye.
Great. Bye.
Thank you.